Welcome back to the channel. My name is Leo, and in this video here, folks, we're doing a stock analysis on Intel. Now, if you've been following the channel for quite some time, I have been talking about my stock research tool, and that's the primary tool I use to analyze these companies. Now, take a look at this, folks. If you follow my Instagram account for whatever reason, I posted a very special sneak preview of the software, and in this video, here we are, the beta version of the software, testing it out, and everything's been running pretty smooth. So take a look at everything that we got here, income statements and cash flow statements. Everything's there's still some bugs we have to work out, but guys, take a look. This is what I've been promising you guys, and it's so close. It's pretty much here, but this is what it's going to pretty much look like. So jumping in to Intel with my software, taking a look at the financial evaluations of this business. This business has hit a 52-week low, folks, hitting at 38.61. We are ranking this company a 9 out of 10. Now, what do those categories mean? These categories look at the income statements, the balance sheets, and the cash flow statements to grade this company out of 10. And where Intel lies is fairly high. So let's see what they're doing right and see what they're doing wrong. With our 5-year PE average, we are sitting at a 14.05. We want this number to be underneath 22.5. And guys, take a look at this. Currently sitting in our trailing 12 months is 6.38. 14.05 is our 5-year average. That is incredible for a tech company. An amazing current ratio, an amazing return on equity average, sitting at 23%. We want to see this over 15%, folks, and we have that easily. Huge EPS growth. A decent debt to equity ratio sitting at 35%. Share dilution is negative 3%. And that means over the last 5 years, they've been buying back shares. This is what we want to see. We want to see this number going down, or at the very least, staying the same. And we have that. The 5-year net income growth growing. Free cash flow has decreased. That's our only point that we're getting knocked off here, is because it has been decreased over the last 5 years, and because they've been using that free cash flow, folks. There's something to keep in mind. The full story is this: they've been using their free cash flow to grow the business. They're putting up some foundry plants, I believe, in Ohio and somewhere else. I can't remember the location. I should know this. I should know this by now. But they are reinvesting that money into themselves. So we're going to see a little bit of a decrease, but for future revenue, for future cash flow, it will be worth it. Our return on invested capital average is sitting at 17.89% for our 5-year average, and our trailing 12 months is sitting at 13.67%. These are phenomenal numbers. We want to see this over 10%, and we have that easily with Intel. They know how to make a great return on their money. They know how to run their books efficiently. I'm a fan of this company. Great Piotrowski score sitting at 7. We want to see this number between 7 and 9, 9 being the highest that we can possibly get, and a great Allman Z score. So pretty great stuff here with Intel. And if you watch my earlier videos, folks, you know how janky the software looked before, but here's what the clean interface. There's still some nuances that we're going to be figuring out. I'm so happy to show you this, and I'll do a full walkthrough of it, but it's so much more cleaner. And obviously loving the support that you guys been giving me thus far. I'm so appreciative. Jumping back into the evaluations of Intel. The reason why I like this company is that they have strong free cash flow growth. They have strong revenue growth. And we'll go up into the income statements here, guys. Take a look at this. Boom, pull that up. But take a look at this, guys. Revenue growth. Look at these numbers, folks. Just straight up increasing over time. And the stock price is so low. We'll go back to our stock spec page, guys, sitting at $38. I'm loving this. This has to be fixed. We'll fix that in a second. It hasn't gone down to 0. It's just, but over the last year, take a look at that. We can just bring it back to 20. What was our peak here? Oh, the 52-week range, we've hit $57 a share, and now hit a low of 36. I'm loving this. I'm loving these low prices. I love when companies irrationally just get beat down. So overall, in the financial evaluation section of Intel, they're doing so many things right. This free cash flow growth, even though it has been decreased, it doesn't bother me because I know they're reinvesting into themselves. So jumping into our company metrics category, just to see where this company is currently standing and where they're going, take a look at this, folks. So this is where you can kind of cross-examine and cross-compare what the business is doing. 5-year free cash flow is 14.4 billion. Our trailing 12 months free cash flow is 9.6 billion. The major thing that bothers me about this business is the dividends that are being paid out. Because we've been reinvesting all this free cash flow back into the business, I would rather they just stick with that principle than pay out the dividends. Listen, I like a good dividend. It's the cherry on top of a stock, right? It's a little, bonus that you get, right? Because you get part of that free cash flow. However, and I know a lot of investors are suckered into companies that pay a dividend. However, with the case of Intel, I would rather they just take that money that would have been paid out to dividends, the 5.6 billion, and just reinvest into the business. And that way you'd have upwards towards, you can hit your 14. You know what I mean? Well, not really 14. If your free cash flow is sitting at $9.6 billion, that's more than half of your free cash flow being burnt towards dividends. Why not just have all that money in your back pocket? And that way, once you reinvest into yourself, you're offering shareholders a lot more value later on down the line. You can reintroduce the dividend and it wouldn't be a problem. But right now, if your focus is growth, stick to growth. Stick to growth. Don't stick to the dividend. However, you'd upset a lot of investors if they did that. That's the only thing. But listen, folks, 38.61. Let's see where that lands here on our price analysis section. What we're going to do here, folks, we're going to fill out these boxes here on a 10-year analysis, not 20. And we're going to figure out what a fair price to pay for this business would be. I'm going to fill out these boxes and I'll touch base with you in just a quick second. We took a very conservative route. If you've been watching the channel for quite some time, you should know how I roll. I did 2%, 3%, and 4% revenue growth. Profit margin, I gave it a slight haircut because I believe they could probably hit those profit margins, but the more I cut off, the more margin of safety I give myself. And if they beat my numbers, folks, that's what we want to see, and it just accentuates our point. Free cash flow margin, same thing, 17, 18, and 19, because they've shown that they could do 19 over a 10-year period. So I'm going to just go with those old numbers, even though they've proven that they can do 5-year at 20%. So 17, 18, and 19, free price to free cash flow, I'm doing 12, 14, and 16. Same thing, 12, 14, and 16, as well as desired return. We always do lucky number 13. We're going to hit calculate and see what we have with this business. Oh, that's a little bit painful. But look, folks, that's why it's an open beta or a closed beta. I keep saying open beta. That's why it's the beta. Guys, take a look at this. 53.55. 53.55 is our average calculation. 40 on the low end. 67.21 on the high end. Currently sitting at 38.61. Currently sitting at 38.61. Oh my God, I can't speak today at all. And look at these revenue growth numbers. 2% revenue growth over the next 10 years. I think they can easily do at least 4 or 5. Like listen, this is a massive company. It's almost it's a $157 billion company. Before it was a $200 billion company. But look at that. I gave it a strict discount. So you pay $53.55 for this business today. You can somewhat assume you should be able to make a 13% return over the next 10 years. And here's the things you got to look forward to. There's a chip shortage. They are investing back into themselves to build more foundries and to make more chips. They are the giants of the semiconductor industry. They're competing against NVIDIA as well as AMD. AMD is a phenomenal company. They're a phenomenal company, but in terms of sheer size, Intel just towers over that business. They're bringing in just on free cash flow what AMD is bringing in revenue, and they're just buying up land. They're making foundries, they're making moves, and as we go further and further into the future, where computer chips are going to be in such a high demand, more than what they are now, and everything becomes from electric vehicles to smart fridges to whatever have you, everything needs a chip. and Intel is the company that's running the forefront, and that's why I like this business. What am I doing personally? Well, I'm doing this. I'm buying more shares of this company, but I've done my due diligence, and this is why I like when the price goes down, because I'm allowed and I'm able to buy more of this great business at a great price. And folks, if you're loving the video, hit that like button, hit the subscribe button. This software that I'm showing you, it's so close to being released so that you can analyze companies within an instant. I said there was going to be additional features, and I stayed to my word. So along with the income statements, the cash flow statements, as well as the stock spec page here that we are able to analyze companies, we have visual representations with charts. We are able to scan these businesses and actually see what the total assets and liabilities are, see what the shares outstandings are looking like, who are the top 10 institutional holders. There's how it compares against SPY over the last 10 years. There's so many things that are going to be added to this software here. You're going to love it. So guys, that's the software so far. Currently in the beta, but we have everything I said I was going to get you. There is more features to be added to this software. We are just getting started. I started this channel and took it seriously back in January, and Intel was the first company that I analyzed. And since then, we've grown to 275 subscribers, and we're not slowing down. I am so grateful to have you guys in my corner as niche value investors, and I know, and I look at all the comments and all of the responses you guys have been giving me with the video, and it keeps me going and to make this content. So, but ultimately, I want to get you this software because so you don't have to wait for me. You don't have to wait for video, and you can actually go and analyze these companies within an instant, because I believe to become a value investor, the only thing you have to worry about is your internal emotions. But this software can help you tackle those problems, because at the end of the day, folks, it's numbers, and it just comes down to your mindset. And that's what we're trying to conquer on this channel. So thank you so much for the love and support. That's my thoughts on Intel. $38 is currently sitting at. The average calculation comes out to be $53.55 with extremely low revenue growth numbers and extremely low PE ratio numbers. Guys, to me, it's a buy all day, and you know me, I'm gonna probably pick up some more shares. Does that mean you should be buying more shares? No. Like always, do your own due diligence, and this software here is gonna help you with that. Until next time, folks, I'll catch you in the next one.